Since then, you see that there are other countries. If you see the United Kingdom, to see it's quite accurate, has signed the agreement with Hong Kong on the 21st of June of 2010. To be, if you want complete information, with Switzerland, it has been, a double taxation treaty has been paraphed. In other words, when a double taxation treaty is negotiated, the negotiating teams of both countries get to an agreement, which is the case since last week with Switzerland, and then both teams go back home and get the okay of their government, and then there's a meeting where it is signed. So Switzerland will be the third country in a while. The purpose of this meeting, of my speech actually, is to explain to all of you that actually it is in the biggest interest of all European companies that want to invest in China to do it through a Belgian company, and it is in the interest of all Chinese companies to do it through Hong Kong and Belgium. So I will explain to you why, although you have obviously China, Thailand, Vietnam, Brunei are not Indonesia, Kuwait, and are not European countries, but I will explain to you why Belgium is actually more favorable than the other European countries that you will find on this list. So the double taxation treaty between Hong Kong and China is quite important because at the end of the day, the Chinese company that wish to invest in Europe will want its money or the fruit of its investment to come back in China. If it does it through Hong Kong or not, the company and the investment itself comes from China. And the same thing for a European country that wants to invest in China. At the end of the day, the investment is in China and not in this very small territory, which is the territory of Hong Kong. So, in very summarized, this double taxation provides that maximum withholding tax between Hong Kong and China on dividends is 5% when the mother company has at least 25% of the company in the other country. The withholding tax on interest and royalties is maximum 7%, and capital gains on shares are taxed in the country of the mother company. Now, for Chinese companies, it is quite important to know which withholding tax exists in Hong Kong, because the money is supposed to come back to China, of course. And although there is a maximum of 5% for dividends and 7% for interest, one should know that Hong Kong does not levy any withholding tax. So this will allow me at the end to explain to you why this schema that I elaborated for investing from China to Europe is completely tax-wise transparent. There's no burden of any taxation by passing through Hong Kong and Belgium. So there is the first double taxation treaty, fully comprehensive double taxation treaty Hong Kong has ever signed with the country, even older than the double taxation treaty Hong Kong has signed with China, with mainland China, is the one signed with Belgium, dated December 10th, 2003. So Article 7 is the same as the one we saw as far as the Belgo-Chinese treaty is concerned. Article 10 provides, even though Hong Kong nor Belgium provides for any withholding tax on dividends, the treaty itself warrants a Hong Kong company that there will never be any withholding tax withheld from Belgium on any dividends paid out to a Hong Kong company, and the same agreement warrants a Belgian company that no withholding tax will be levied from Hong Kong if a Hong Kong company pays out dividends to its mother company in Belgium. Interests same thing. Now interest, there is a maximum of 10% provided by, provided by the treaty, but the treaty provides for a lot of situations where no withholding tax can be levied by any country, which in other words means that if you go to a good tax lawyer, you can be sure that no withholding tax will be levied by neither country, Hong Kong or Belgium. Royalties, there's a maximum of 5%, which will be withheld by Belgium, but is not withheld by Hong Kong. So, basically, I would be lying if I would tell you that the double taxation treaty on itself between Belgium and Hong Kong is much different than the ones Hong Kong has signed with other countries, other European countries. We have the UK since the 21st of June, the Netherlands, Luxembourg, and so on. What really makes a difference, as far as I am concerned, is the Belgian internal tax regime on holding companies. So, the dividends that a Belgian mother company perceives, be it from a company in another country of Europe or from a company in Hong Kong, are exempted for 95%, which means that actually only 5% of the dividends could theoretically be submitted to Belgian corporate tax. In practice, actually these 5% are never taxed. Why are they never taxed? Because you have much deductible expenses that are possible. And actually, if you don't have any expenses, if you don't let offices, if you don't have employees in Belgium that reduce your tax burden or your taxable base, even then you could, by financing the Belgian company partially through capital and partially through loans, make sure that these 5% are never taxed. So basically, there's no taxation on dividends. Then you have, and this is something Belgium is quite proud of, and it's a quite complicated system, to tell you the truth. In 2007, I did a speech of 50 minutes on the deduction of notional interests themselves, so it's already late. I will not submit you to 50 minutes of notional interests, but I will read you a little part of an article I wrote in 2007. So the notional interest deduction allows all companies incorporated in Belgium to deduct a fictitious interest on their net assets from their taxable profits. In other words, they can deduct annually from their taxable income an amount equal to the interest they would have paid on their aggregated equity in case of a long-term debt financing. So actually, to explain to you, what did our government understand is that a company has two ways of financing itself. One is through capital, the other one is through loan. If it finances itself through loan, it has a lot of inconveniences, which is the activity is much less solid. The first problem you have, you're in bankruptcy, and you have people unemployed and so on. But most Belgian companies were working with a lot of loans. Why? Because when you finance through loans, you have the interest that is tax deductible. So you have the mother company. If the daughter company needs 1,000, you put 1,000 into as capital. The daughter company is stronger. But you have, if the 1,000 make 100 taxable base, you are taxed on 100. If the mother company would have put a capital of 100 and lent 900 to the daughter company, the 900 of loan would have given the company the right to deduct an interest on this 900, which would have absorbed or partially absorbed the 100 of taxable base I was just talking about. I'm sorry, I know it's quite quick, but time is running. So, based on this based on this idea, the Belgian government has said if we want companies to have better capital, we need to give them the same advantages on capital than they would have would they be financed by loan. And hence, when you enter your tax return in Belgium, when a company enters its tax return, it has the right to calculate an interest of approximately 4% on its own net equity, as if it would have lent this money and deduct it for tax purposes. This is a very strong tool and a very interesting tool for holding companies, because this allows holding companies to be quite sure they will never be taxed corporate tax-wise in Belgium.